Selling a property in the United Kingdom, well, you need to think about the mistakes you could make, which ultimately means that you be paying more money to HMRC. Check out this video as I understand. Hi everyone, my name is Simon Mishevich, and in this video we're going to be talking about selling a UK property and the mistakes that you can make, especially when reporting to HMRC within 60 days of disposal. If you want to discuss anything in this video about minimizing capital gains tax, reporting, etc., then feel free to use that QR code. Use the code YouTube15 to get a 15% discount. Also, if you're looking for another property tax accountant to help you file taxes correctly going forwards, then again, use that same QR code and you'll get an opportunity to speak with our customer services manager. If you're wondering how much capital gains tax that you'll be paying, there is a free tax calculator. Use the link in the description box below to get that link and just calculate CGT for yourself. If again, you're looking for some tax advice, feel free to use that QR code. All right, so you could go to HMRC's website to read up about tax when you sell property. Just do a Google search, it will come up. But the problem is with that is that you could be confused with the amount of detail that's in there. Also, if you're looking for a mortgage, buy-to-let mortgage, because you're reinvesting that money, then feel free to use that code or the link in the description box below to get the best rates using the best mortgage broker. All right, so I'm going to talk about many different mistakes here. And the first one is HMRC place fines and interest on unpaid taxes. Now, straight away, the thing I want to say to you is that the reporting of taxes when selling a property is 60 days. So you need to bear that in mind. You'll need to bear that in mind that you've got 60 days from selling the property to paying it over to HMRC. So make sure you do it on time, otherwise interest will be ensued and it can be quite costly. Mistake number 2 is selling a property before selling. So tax planning comes before you sell property, not afterwards. So we have helped many clients like you looking to sell buy-to-let properties, minimizing CGT, but we always give advice before they sell it because there may be an allocation of income. We could use deed of trust. There may be other investments they can use to reduce that CGT, but we can't do any tax planning after the event has happened. So the horse is bolted. And that can happen to you if you don't get the right tax advice. Now, one of the things I want to talk about is how we helped clients in the past, even recently, is we can help you minimize it. We can talk about transfer of property from one person to another, one spouse to another, helping you to leave the UK, or indeed to help you buy other types of investments, which will reduce your CGT. Depending on your situation, everyone is different. Everyone's circumstances is different. So I can't give you general advice on YouTube, but I certainly can give you specific advice when you book calls with us. If you think about leaving the country, then you're wanting to exchange money, but don't pay the highest interest of the conversion charges that you're using a bank. Instead, use that QR code or a link in the description box below to get the very best conversion rates for you. CGT error number 3. And that's not keeping receipts because costs are not deductible against CGT. If you've lost receipts, you cannot put in a blanket £20,000 cost of refurbishment. If you do not have the receipt, HMRC can make inquiries. They can ask you to produce invoices and statements that show the refurbishment cost that helps you reduce CGT. If you're unable to produce those receipts upon inquiry, HMRC will have the right to recalculate how much tax you should have paid, and they can impose a penalty and interest for false misrepresentation of your situation. So make sure that whatever number you put in your tax return is right and you have the evidence to support it. Another example is sales price. Now, when you sell a property, typically you will say, I have sold my property for £300,000, no problem at all. But what you need to think about was, are there any costs or fees associated with that sales price? Well, let's have a look at this. You could ignore the sales price number, so you might not put the right cost against that actual sale, someone helping you to sell that property. So ignoring professional fees as an example of that sales price, especially if it's commission based. help you sell property, an agent. It could be a friend of yours. It could be another organization. You will have fees. Make sure you put those down. Ignoring mortgage redemption fees. That's a big one on sales numbers. Again, depending on what it is, but if you sold your property, you've not put that cost in, it can be quite costly. Incorrect currency conversion rates. You could really make a mistake if you sold a foreign property and then converted it incorrectly into UK sterling at the wrong rate, meaning that you're paying more CGT. Talk about currency exchange. Don't forget to use that QR code to get the very best currency exchange rates for you. All right, so here's another mistake people make on purchase price. So when you're buying the property, what fees could you have missed there? Well, the first one is, again, ignoring professional fees. You may well have had a conveyancing solicitor who also helped you to calculate stamp duty land tax. I've had many, many clients that tell us the purchase price, well, I think it's about £300,000. And it's such a round number, you think, well, hold on a minute, it normally isn't just a round number. Can you give me your completion statement? And sure enough, stamp duty land tax is in there, professional conveyancing fees, and other fees as well, such as bank charges, mortgage arrangement fees are normally included. As a result, they was going to be paying more capital gains tax because they didn't tell us all the information. We had to dig that information out of them, helping them to reduce CGT. The other one is capital items. So if you've bought a property, you may have refurbished it, you may have made improvements to the property, which you have not already expensed against your self-assessment tax return. Your accountant may have said, well, you're not allowed that cost because it's not allowable against your income, but it will be a capital cost in nature, which helps you save when you sell the property. But then people forget that they've done it. Typical example here is as follows: extensions and development of a property. We see this typically when people buy a home, they intend to stay in it, but then what happens is that they rent the property out. But during that time, they bought the property, let's say 200,000, spent £50,000 on it, and then rented the property out. When they come to sell a property, they forget or do not have the receipts for the property development of that £50,000. So it's really important, even if it's your home, to keep receipts, because you just never know if it is going to be useful for you later on down the line. Items that not expensed on refurb costs. So again, you're not allowed to have the costs offset against your rental income and against your capital gains tax. So it's one or the other, but it is up to you to understand when it's right for you to expense those items. Is it now against your rental income or later against your capital when you sell property? Legal matters. Now, again, we could be looking at legal matters here when we're talking about property being sold. You may have been defending your title on that property. There may be disputes, tenants, etc. Well, those costs, if you were trying to evict a tenant, you didn't have any rental income, you can offset that against your capital gains tax liability. So always think about what receipts you should be keeping when selling property.